All right, let's get our panelists up here. We're going to be starting an event. Well, this entire event today is called From Evolution to Revolution. So we heard Mindy talk earlier about the urgency for action, for change. Patrick talked about a sustainability revolution. Laura spoke about immense challenges and opportunities in developing countries. This panel is going to build on all of that and on the discussion on how the green bond market has evolved from the early days. So we're going to hear a wide range of perspectives today. We're going to hear from a mortgage finance giant. We're going to hear from a green sukuk issuer who's also a securities regulator. We're going to hear from mainstream and specialized investors and from an AI quant expert. So I don't like panelists to introduce themselves. It just kind of drags things and it's awkward. So I'm going to introduce the panel, ask them a couple of questions, and then we're going to have a discussion and open it up to the audience. I hope we mix it up a little bit. I hope we keep things interesting. So in alphabetical order, we have Izlan Zanial Abidin, Deputy Chief Executive, Securities Commission, Malaysia. Thank you, Izlan, for coming. Roger Beauchemin, from President and Chief Executive Officer, Addenda Capital from Canada, another Canadian here. Thank you for coming. We have Carmine de Franco, Head of Fundamental Research at OSSIAM. Thank you. Chrissa Pagitsas, Director of Green Financing at Fannie Mae. And last but not least, Anna Pot, who's the Manager for Responsible Investments at APG Asset Management. Thank you all for coming, and thank you distinguished guests for coming as well. All right, we're going to ask just a couple of introductory questions. I'm hopeful that our panelists will keep the answers brief. Let's jump in with Izlan. Thanks for coming. You're bringing sort of the emerging market, Islamic finance and regulatory perspective. So we're going to start with you. So if you can just quickly tell us a little bit about some of the groundbreaking initiatives that you've got going on in Malaysia, promoting sustainable investments in the region, and how you've embarked on this journey and what challenges you're seeing and how Malaysia is emerging as a hub for Islamic finance. And I'm going to ask you to do that briefly. So good luck.
All right. Okay, I guess the first 30 years of this, my response would be very quick. Malaysia has been developing the Islamic finance ecosystem for over 30 years. So this takes me to about 2013, and we were sitting down on the management of the commission and deciding, what can we do in terms of expanding the scope of Islamic capital market further. At the same time, we were aware that the SRI agenda was actually gaining significant traction, particularly in the developed economies. And we thought that given there's a lot of alignment between the underlying principles of Sharia and sustainability, this was actually one way that Islamic finance could contribute significantly to the global sustainability agenda. That took us then to developing a 5I approach in developing the SRI ecosystem in Malaysia, riding on the ecosystem that we already have for Islamic capital market. So the 5 I's are basically the issuers, the investors, the instruments, internal compliance, which is essentially governance, and information architecture, which is sustainability and integrated reporting. Work still in progress. So we've actually, the first, I suppose, product that came out of this ecosystem or the 5I approach was the SRI Sukuk framework. And we have defined SRI in a fairly generic term, sustainable and responsible investment. Others may use other acronyms, but that's how we have defined this space that we were embarking into at that time. So we introduced the SRI Sukuk framework, and there were 4 categories that we sort of identified within the SRI Sukuk space. And just to explain briefly why we needed to be quite specific in identifying the segments is because we wanted to encourage the issuance of sukuk, SRI Sukuk, and we were applying for incentives from the government for issuers and investors who invest in such products. So part of the requirement is to be quite specific. And the 4 areas are sort of projects that manage natural resources, energy projects, energy-related projects, social impact projects, and projects that develop Waqaf assets or Islamic endowments. And out of this, this was introduced in 2014. 2015, we had the first SRI Sukuk issuance, which was for education, and which are under social impact category. And then last year, we had the first global green Sukuk issued under this framework, which since then has 4 other issuances under the framework. So there are 5 SRI green sukuk issued out of Malaysia. And I think we work very closely with some of the stakeholders, including World Bank and our central bank and other stakeholders. So that's how, I guess, we got here.
It's a good start. Thank you, Izlan. Excellent. All right, moving on to Roger. Let's talk about, so Addenda, I presume people are familiar, they're a multi-asset investor, originally interested in green for your fixed income assets, right? But more recently focusing on themes like gender. How have you seen your client interest evolve is one question I want to ask. And then are they more interested in ESG as risk management or impact using the SDGs as a framework? What are you sort of seeing around there?
Yeah, I mean, I think it's been an evolution in a way. We started off with integrating ESG in our decision making. A bit like Patrick said earlier, I think what makes us better investors, we make better capital allocation decisions. And then, of course, we started wanting to do good with our investments. So when the green bonds came out, we were early adopters, and we have a fixed income tilt within our assets. But more recently, in the past 3 years, we've been doing impact investment, so impact-specific mandates. So we have market-like financial returns for our clients, but then we have objectively measurable, and before we invest, sort of what we call societal outcomes. And those can be thematically driven by clients, or we've also set up our own unitized fund. So it's a fund where smaller investors can come in and find good outcomes. So they try to align their assets with often, especially with endowments and foundations, with their granting policy. So if it just makes much more sense. But it's been a journey. It's been interesting. I was thinking of an anecdote that we started off doing these impact investments in our traditional mandates. So these were not. We just told clients that that's how we approach it. So when the province of Quebec issued a green bond recently, we had a client phone us saying if we'd purchased any, and we told them the amount. They were so pleased they put out a press release saying that they'd done. So the client, that's really where it's changing now, and I think that dynamic is just beginning. So, and for us, I think the power of the green bond is the power of the platform, from the metrics that you're looking for, the KPIs we need, and also how we need to report back to our clients. And now what we can do is roll that out to other societal outcomes, and obviously the SDGs, and we have to pick and choose amongst those. But that's just the start. The gender diversity one for us was a complete layup and very much in line. And so we were very happy to subscribe to that.
That's awesome. And it looks like it sparked the interest of Anna. I think that this is a natural to turn to you. So EPG has been collaborating with other investors, mostly Dutch, but with a focus on the SDGs as a framework, which we were just talking about. So let's talk a little bit more about that, about mapping your portfolio to the SDGs. And does that channel capital towards sustainable activities? And do you think it addresses the sense of urgency that we need?
Yeah, thank you. And thank you for mentioning the Sustainable Development Goals, but also highlighting the urgency, because for APG, this is aligned with our investments and our investment approach. Because at APG, we are investing the pension savings of 1 out of 5 families in the Netherlands. And we need to make sure that we can invest it today, and we can also invest it tomorrow. So therefore, we look at investments that provide returns. So we look at that, risk, return, and cost. Therefore, we look at our companies. Do they operate in a responsible way? So responsible business conduct, the ESG integration that we're talking about. But on top of that, meeting that long-term objective, we also ask our investment teams to walk that extra mile and to find those investments that not only provide returns, not only operate in a responsible manner, but also through their products and services contribute to any of these sustainable development goals. So that's our approach. But that's all nicely said and communicated. But what does that mean? Because we know other investors are saying the same things. And I think that's where our responsibility is, to not screw it up. The Sustainable Development Goals, it has a certain, a vibe. So let's make sure we do this right. What is it that we do? We want to be absolutely clear that what we say is what we do. So we are working on what we call a set of taxonomies. What does Sustainable Development Goal investment mean? We call that sustainable development investments. And as we have worked on that set of taxonomies that you, by the way, all can access on our website, and please use it, and scrutinize and, provide us comments if you think it should be better. But the point that I want to make is it's not something that we can do alone. So while we are working on getting that set of taxonomies right, and we is not only our responsible investment team, but also all our investment teams and portfolio managers contributing to it. We're working together with other investors in the Netherlands, other pension fund investors, also in the Nordics, to make sure that we are aligned. And if we talk about impact investing or sustainable development investments, we mean the same thing. Mm-hmm. On your point about allocation, how does that inform? So, as I said, all these requirements that we set on to our investment teams to meet, on top of that, we ask our investment teams to find these sustainable development investments. And our client have said, in 2020, we want to have doubled the capital that we have allocated to this type of investments. What does that mean? It means by 2020, we should have at least 58 billion euros invested in this. Part of that is green bonds. I think we're one of the larger investors in green bonds. I learned yesterday we're almost approaching 7 billion euro invested in green bonds. But again, let's do this right. Let's not screw up. Let's work together and define the integrity and to build from that and grow it, because we cannot be complacent. This 58 billion SDIs, that's just the start, as we have learned today.
That's great, Anna. Thanks so much. Chrissa, you're next. So in the early days of green bonds, supers and agencies dominated and clients were looking for ABS and MBS. But I think your colleague, Liza Bozzelli, joined the Green Bond Symposium in 2013. Since then, you've rolled out a suite of green lending products financed by green securities, and now you're one of the largest issuers in the market, right?
We are the largest issuer.
The largest, yes, okay.
Actually.
Well, tell us a little bit about what you've seen and how this has changed the way you're doing things and what's driving the demand.
Thank you, David. So Fannie Mae, many of you, of course, know, we're US-based. We only operate in the US, and our mission is to provide support, more specifically, affordable, quality housing. That's both for single-family owners, but also for renters. So we actually support apartment buildings, which is a major, important type of housing stock in the United States. And when we looked about 8 years ago at what the opportunity is to support, in particular, first that apartment housing stock, we realized that those apartment buildings generally were very energy inefficient, water inefficient, and really were not delivering on saving money for tenants, who often are low income, but also investments weren't being made in them to secure that housing for the long term. Housing in the United States is a very difficult asset to not necessarily finance, but to construct due to increasing construction costs. So we actually must very much preserve what we have. And that leads really to the dovetailing with energy efficiency and water efficiency. So what we did starting in 2011 is roll out our first green mortgage loan product for apartment building owners. What we said is, look, how do we encourage you to make those investments that are needed, again, to make that property more affordable, to make it stable for the long term, and to reduce energy and water consumption? So we offered lower interest rate. We now pay for an energy audit, 100%, and we actually increased the size of that loan in order for those improvements to be made. We started out small. We started at the $40 to $50 million range for the first couple of years. All of those loans were then securitized as green bonds to $3.6 billion in issuances 2016, and now to $28 billion in 2017. And we're on track to do the same as well. So that $28 billion makes us the world's largest, but I don't think that that's the piece actually that we stand on the most. What we're trying to do here is show that MBS, specifically MBS, is a very viable, reasonable, logical vehicle to transform housing stock, not only in the United States, but also globally, to a low carbon future. while we would, of course, like to have LEED Platinum buildings to be built new, passive house buildings to built new, we can't forget that the vast majority of housing in the United States and globally is existing, and that's not going to change. So that is pretty much the most important part for us, is to not only be a leader in the United States in green bonds, but also have a leadership stance globally to show that this can be done, particularly through an MBS structure.
That's great. This panel is looking forward, so that's fantastic. Thank you so much. Carmine, we saved you for last since you're bringing the quant perspective, so thanks for joining us. Can you tell us about OSSIAM and how AI and ESG are revolutionizing investing for impact? And how is this different in your view for equities and fixed income?
Yeah, thank you. OSSIAM is a small ETF provider based in Paris. We are known to be active in what they call alternative investments, so no things that follow the standard benchmarks. And we moved into ESG deep down at the corporate level, at the main corporate level since 2014. The premise for us was it's unbelievable that we can build portfolio and not take into account what's really is the environment of businesses. Just taking risk and return, that's it. It's not going to work. The main issue is that usually when we talk about ESG, one metric is too narrow. The world is too complex to be defined by just one metric: good, bad, modest. On the other side, when you go to look at specific indicators, specific features of each company, then you expand dramatically the set of things that you can look at. In this framework, how do you choose? How do you compare companies? What's an opportunity? What's a risk? So this kind of thinking is out of the human capabilities. We are not good at looking and identifying profiles. But that's it. The point is we can use useful stuff that are already available, which is artificial intelligence. Actually, what we do is more the machine learning, which is one part of the artificial intelligence field. But the idea is very simple, is let's suppose, and I do believe as a citizen, as a portfolio manager, let's suppose that there is a strong link between ESG profiles and economic and financial performance. How do we link it? We cannot link it by doing screening, so we have to apply this machine learning, try to identify profiles and see what kind of things can have a material impact on financial performance. Because at the end of the day, and I liked the title of the conference, From Evolution to Revolution, as the French would say, you are the avant-garde of this, but now we have to push lots of investors and we have to deploy capital. One of the growing aspects of the capital markets is what they call index funds, ETFs. There is a lot of money there. We need to deploy, but many investors are still afraid that, okay, I can do ESG, but then what if it costs me 100 basis points? Well, that's not true. We need to stand up and say, it's not only mandatory to save the planet, it's just good for your financial performance, but do it in a smart way. So that's what we're trying to do. We're quite small, so we don't pretend to change the environment, but as someone before said, we need to start somewhere, so here we will start.
That's great, Carmine, thank you. And I want to come back to that AI and get some other reactions in a second. But let's look at the audience and see if you have any questions. And if not, I'd also love if anyone wants to react to anything that they've heard from the various panelists, also please feel free to jump in. But I'll turn to the crowd and give you guys a chance to arrange your thoughts. We're a little tight, as normal in these conferences. You always get a little bit abbreviated. Yes, great, thank you.
This is on. Thanks. For Chrissa from Fannie Mae, can you see a way to work with municipalities to try to get the PACE financing issue for homeowners addressed? The state of California, obviously their goals. That seems to be one of the stumbling blocks for property assessed clean energy for homeowners for that to really take off in the U.S.
So PACE, Property Assessed Clean Energy, is a form of financing, if you're not familiar with it. which is mostly targeted for single-family owners, but also can be used in commercial properties as well, or by commercial properties. It's different than a mortgage, which is that it can occur probably any time. It does not have to occur at the time of the mortgage, which is usually the largest capital event for a single-family owner and for a commercial property as well. So today, Fannie Mae, as well as our sister company, Freddie Mac, are prohibited from doing PACE financing specifically by our regulator. So we have actually turned to green mortgages as a way to solve for that problem, to provide additional capital for owners who want to make those energy efficiency improvements at the time of the mortgage. So in terms of a solution, Fannie Mae itself is not in the way of the PACE solution. It is a solution, however, really more at the conversation for the municipality as well as for our regulator. So we feel we're delivering on green mortgages and then for green bonds in a different way than the PACE solution.
That's great. Any other reactions up here before we turn to other questions? No? Great. Anyone else in the audience? Because we can move things along. Did anyone want to react to, sorry, over here? Yes, please. Hi, we'll get a mic down to you. Thank you. Sorry, the podium was blocking me from seeing you.
No problem. I had a mic as well quick. It's to APG. I mean, one of the things that have positively surprised me, that is the engagement we're seeing from the EMs, your portfolio managers. Would you mind sharing a little bit of the internal kind of dialogue and how you managed to do that? Because that's unique.
Yeah, happy to share that. And I think that also relates to what has been said before and also in the panels before. Let's not be complacent. In order to bring up the scale, we need to work on it, everybody. Not only the people in the institutions that are running the sustainability or impact programs. Let's get it out there. Let's get the portfolio managers and analysts and the mainstream funds involved. So yes, maybe you classify yourself as a small firm, but we all have our job to do and our contribution to make. So that's the first point. Then the second, and I think that relates also to the point, how does it risk? Does it have a negative impact? Does it risk your investment? Does it have a negative impact on your performance? In order to tackle that issue and that criticism that you get all the time, involve your portfolio manager and involve your investors in your firm. How did we do that in response to your question? At APG, we have responsible investment approach now for 10 years. And along that journey, we have further integrated and further embedded it in our investment strategies. And in our latest policy overhaul, we have introduced what we call an inclusion policy, which means we want to be able to explain and be held accountable for what we have included in our portfolios, not what we have excluded. And who makes the portfolio who makes the investment decisions? It's the portfolio managers. So they should be involved in first developing the methodology. What's a good and what's a bad? What's a leader, what's a laggard in your portfolio? So that's the first step in terms of integrating and having that joint collaboration in defining sustainability by having our portfolio managers involved. So they were a close partner in the journey to define our methodology and to define what is a leader, what's a laggard. Second, and that's I think where the biggest change has come in, is that we say for each investment that we make, we, and it means also the portfolio manager and the analyst, are able to explain them on the four aspects of the quadrant. The risk, the return, the cost, but also the ESG. Saying as an answer, we're invested because it's in our benchmark, that's not good enough of an answer. So what does that mean? Can we then not invest in laggards? No, we can. We can invest in laggards, but if you do that, first, go back to one, be able to explain, but two, you, portfolio manager, analyst, contribute to making that company a leader. In other words, if you're investing in a laggard, we call that a laggard against our methodology, it requires the portfolio manager to engage, to improve the performance of that company. Hopefully that will then bring us to, in the long term, invest in more leaders and being part of that journey to change.
That's great, Anna, thanks. It's no time for complacency. I mean, the Sustainable Development Goals were just set a couple of years ago, and the very first one, the first SDG, is ending extreme poverty by 2030. The World Bank just put out a report in September that shows that already on current trends, we're not going to meet that goal by 2030. So just a couple of years after setting the goal, on current trends, we're already off track. So this is important not just for the investor community, but for the global community, not to do business as usual, but for everyone to step up their game on this front. So that's a really critical point. Thanks so much. I want to save a couple of minutes for the last question for the panel. So let's just see if there's any other questions in the audience. Yeah, I see 1 and 2. So I'm going to do 1, 2. Oh, or 1, 2, 3.
A quick question. What procedures are you advocating to reduce the occurrence of greenwashing, where people claim green benefits such as, low polluting diesel or low or clean coal that aren't really green?
Great. I wanted to ask, let's get a few questions lined up and then we'll have the crowd react. So if we can do these last two as well, please.
Yes, so my question is actually an extension of that to some extent. So earlier this week, BlackRock launched a green bond ETF. So they're certainly not the first one to launch a green bond ETF, but when the world's biggest investor decides that there's enough liquidity to launch an ETF, it's clearly an interesting market signal. So I guess kind of playing off that though, is that democratizing access to green bonds, or is it also kind of cause for concern where they might be taking a larger view of what they qualify for a green bond, given their needs in a very liquid, potentially very large ETF?
That's great. And one last one right there, and then we'll turn to the panel. Thanks very much.
Hi, I'm from the GW Law Environmental and Energy Law program. I'm one of the faculty there, and considering we're at GW and we also got students and faculty here in the audience, my kind of question goes towards education, and considering that we are producing the students that are going to go out and become the new clients, your new investors, potentially your new colleagues in the future as well. What do you see as our role in terms of contributing towards this roadmap in terms of green bonds and the sustainable capital markets? What can we do to promote that as well?
Great. Okay, let's start with this one, and then I'd like, if we can, we're just going to go with these three questions for now, please. So let's answer the first, and then for the BlackRock question, I think we'll let BlackRock speak for themselves since they're here. But go ahead, please, on the first question. Anyone who wants to jump in.
Sure, I'll
go ahead, Chrissa, and then Roger.
So I think it is a great question. I think it also makes an assumption that there's only one type of green that's acceptable. I know you're very familiar and it's beyond that, but if we only assume that a green asset, whether fixed income, equity, but basically a green investable vehicle has to be only one type of green, then we're going to limit all of the other types of green things that can contribute to the low carbon economy. So one of the discussion points that we had with Cicero when we went forward with our second opinion this June was, well, is the greenness of our portfolio green enough, right? So the target that we set for a green mortgage loan to be called a green bond is that the property has to save 25% on energy consumption or 25% on water consumption. It's not 40%, it's not 50%, but it's also not 5 and 10%. So I think that there is a danger of greenwashing where people are doing 1 and 2%, but I think we need to make sure that when we look at that asset, we understand what's it capable of, but also not just one time. And I think that's a really important piece and why we're really focused on taking the message of the value of MBS globally, which is if we only do LEED Platinum projects, we're only going to touch 5 buildings. If we reduce the consumption by a quarter on 500,000 units, which is what we've already done, that's mass scale and that's mass transformation. So I think that's the piece that is important. And it does segue into the BlackRock ETF because I think investors get to choose how green they want it to be. And maybe some only want the LEED Platinum, for example, in the passive house, but some are okay with a quarter reduction in energy consumption, and that's a good thing. So I think we have to make space for everybody under the tent, or we're never going to get to any goal 2030, 2040, or 2050.
Great. Izlan, you wanted to jump in here, yeah?
Yeah. I'd just like to say that in a nascent SRI market like Malaysia and most of Asia, I think we rely largely on disclosure requirements by the issuers. And I think it's also in order to allow more flexibility for the industry to grow. And we have had this experience in developing the Islamic finance sector 30 years ago. And as some of you may be familiar, there are different schools of thought in the Sharia principles. But for us, when we look at Islamic products, we allow the different schools of thought views to be presented. And similarly here, we have taken the view that we do not want to have very sort of prescriptive requirements in terms of what is SRI, what is green, and therefore allow disclosure to enable investors to decide whether they feel that's suitably green enough for them to invest in.
That's great. Roger, did you have something there?
Yeah, so I'd sort of start with a premise of transition. This is all about transition, right? So on two levels. First, on the asset management space, I can assure you that in 5 years, ESG integration and impact investing is all that is going to be mainstream. So I think sustainable investment is just going to be called investment, right? I mean, maybe not 5, maybe 10. That's where we're going. So clearly, the other thing is, I mean, for all of us who put in these processes internally, it's very hard to tell portfolio managers what to do. So it's a long process to integrate. So the reality is that you're going to have a lot of firms who are going to say they're doing stuff because they want to and they know and they need to, and they may not be able to, right? But I think in 5 years in time, I think that'll all come out in the wash. Secondly, on the investable side, so this is all about transition from the marketplace as well. So back to your point, what do you call green? What am I calling green? At the end of the day, if we are going, you want to get clean, you can start off with building only clean, or you can clean up what is not clean. And that's where you get into the shades, right? So, and I think there are different approaches. We try not to be dogmatic. We try to engage. We try to see actually the laggards who are going to be, because I think that's where you have the most effect. Right, the Climate 100 Plus, I mean, that's the whole engagement with the largest issuers of carbon, right? So that's the whole point of that. Is to get them clean, you're making a lot more impact. But it's all about transition. And the speed of, the more we have BlackRock talking about it, whether they do it internally or not is not really important to me right now. What's the fact is a lot of people listen to them, right? And that has huge impact.
Did we have BlackRock available first? Great, go ahead, please.
So that's why I wanted to address that question. So a couple of things. Of course, I agree with most of what was said in this panel. On our, we actually put a lot of work and due diligence into looking at every green bond that comes out, and we need to form a conviction that the assets that those bonds will finance are actually environmentally beneficial. And that's really part of my job. And in fact, I think that there's nothing more risky from our perspective than including something in a green bond portfolio that I can't legitimately defend with a client. So I think that that's something that's really important to keep in mind, because this market operates largely within like a self-policing. But I would say that in the years, 10 years now, that this market has grown, I would say that we've seen just very, very few cases where the market has kind of like rejected the green label of a bond. And if I had to give an estimate of the deals that I see, I would probably say that more than 95% of the deals that come through are legitimately green, in the sense that I find no fault, no open door to something fishy or iffy in there. And I think that that's really encouraging. So we view that as a huge reputational risk for us. And because we're huge supporters of this market, we really engage with underwriters, with issuers to make sure that that just doesn't happen, which I think it's really important. And the other thing is that this obviously extends to all sorts of other players, and index providers are really important in this as well. The ETF that you referenced, that was launched yesterday actually, is indexed to the MSCI Green Bond Index. We have helped create that index. We engage with them on a day-to-day basis on what the criteria should be and on how we can strengthen the credibility of that index. So that's for whatever it's worth.
Thank you, and that sort of addressed the first question as well. Do we feel we addressed the third one? Because I know we have a hard stop here, and that some of our panelists have to actually get on the road. So I want to just see if anyone has a quick reaction to the third question. Go ahead, please, Carmine.
Maybe it's a good thing that companies are start to think about greenwashing. I mean, it's a bit provocative, but it seems that they feel that they have to change. So they can cheat for a while, maybe, but then if you engage to reduce your greenhouse gases by 40% in 2 years, and then you don't do it, it's hard. So nowadays, it's about transparency, but if you think positive, it's good. So it means that it's a priority for them. So they can cheat for a little bit, but then they will have to change anyway. So I take the positive side of it.
Did you have a reaction on the third?
Yeah, just not on the generational side. I mean, that's where the ball is going, is clearly, and I think our younger investors, our younger people in the office, and our younger clients just can't imagine we don't approach it this way. So just keep on doing what you're doing, and you'll get there.
Great. Anna?
Yeah, I think I want to echo that point. I think there's a role for everybody. And one role that I wanted to focus on is, the public. In our case, it's the participants in the schemes and their families who depend on that. Ask questions. Claim, it's your money. It's your pension. Make sure that you understand how it is invested. And then, that transparency and accountability ball starts rolling, and then we'll have discussions, and then you disagree. But, that's what we need in order to build the market and to uphold the integrity of this market. Because it's so key to, to have more of these players on board. And yes, not all might be perfect straight from the start, but let's help them and let's build that market of sustainable investments. That's what we do, and that's what I would like to call upon everybody. Just make sure and help that market grow.
That's great, Anna. Okay, I'm going to exercise the moderator's prerogative, and we have 5 minutes left. We have 5 panelists, and I'm going to do a lightning round question for each of them, because this panel is called Looking Forward, so we're going to look forward right now. And the question for each of you, in as short a period of time as you can do it, is, in view of current trends, what are we up here going to be talking about next year? 1 year from now, on this topic, where are we going to go? And I know Carmine mentioned AI, but I want to say, what in 1 year from now? And I'm not going to go down the road. Just anyone who wants to put his or her hand up first. Let's see who's got what.
I'll go.
Go.
So in a year, we'll be talking about how non-green people, basically people that are not in this audience, are actually able to explain green very easily. And I think that's the place that we have to get to, where in our case, green mortgages are not abnormal, but they're normal to the mortgage originator who's been doing it for 25 years. They can talk about green simply and reach a borrower and say, this is why you should do this green mortgage loan, and that's the end of the discussion. So getting education down out of this room to the non-green people.
Fantastic. Did you have something, Roger?
Yeah, I was just going to say, I think we'd have double the audience, a lot more people who really get it, and I think the sense of alarm has to go up. I mean, it's I'm tied to a property casualty insurer. Believe me, climate change, it's happening, right? And we're not doing anything about it. We need to act. So that's
excellent.
Really.
Thank you, Izlan. Go ahead.
I think we will be talking about measuring the impact of adopting green finance, whether it's bonds or sukuk. I think that's something which, at least in the more nascent markets, is not being talked about. We're trying to create the awareness, as I mentioned. A lot of it is still what's in it for me at this stage. So the next step would really be, converting them to being green participants, for them to be able to assess what's the real impact that they're making on the economy, on the community.
Fantastic. Thank you. Carmine?
Yeah, mine's just a hope. I mean, supranational and private sector, I think they're doing pretty well. Maybe we are lacking a bit of the government side. I was reading a paper. I think apart from Sweden, no countries will be on target for the pledge in Paris, which is good for Sweden. It's not good for them.
No, so not good for everyone else.
Maybe next year we will have more countries that will be, put the climate agenda forward. Let's see.
Fantastic. Anna, to wrap us up.
Well, following up on what has been said before, but what I hope we'll have a panel next year is of a diverse group of US issuers, US corporate issuers from a diverse group of sectors. That's what we need to bring that diversity. And then maybe the discussion is going to be about the Sustainable Development Goals. These are commitments from governments. We are investing in sovereign bonds. So we engage with these governments about issues like the Sustainable Development Goals. What's the discussion going to be like?
That's it. All right, we've run out of time. We've got a hard stop. So just, can we all have a round of applause for our panelists, please?